Tesla just reported solid earnings and the stock still dropped. So the real question is, what is the market seeing that investors aren't? And if you're thinking this might be the moment to buy, then this is exactly where you need to look first. Let's break down the report. Starting with revenue. Tesla pulled in $22.4 billion this quarter. That's a 16% jump from the same quarter last year. The main engine was automotive, which brought in $16.2 billion. But here's what's really turning heads. The services segment exploded 42% year over year to $3.7 billion. That's insurance, supercharging, FSD subscriptions, and it's growing fast. The one weak spot? Energy. Revenue there actually dropped 12%, largely due to lower Megapack deployments this quarter. Now let's talk margins, because this is where the story gets really good. Gross margin hit 21.1%. That's nearly 5 full percentage points better than Q1 last year. Lower material costs, higher average selling prices, and a big jump in FSD sales all contributed. On the operating side, income came in at $941 million, up 136% year over year. Operating margin is at 4.2%, which is still modest, but it's moving in the right direction. Cash flow tells the same positive story. Operating cash flow was $3.9 billion, up 83% from a year ago. Free cash flow landed at $1.4 billion. And Tesla's cash pile? $44.7 billion. That's a war chest, and it gives them the runway to fund everything they're building. On the road, Tesla delivered 358,000 vehicles this quarter, up 6% year over year. Not a blowout number, but demand is recovering in North America and Europe after a tough stretch. FSD subscriptions crossed 1.28 million active users, growing 51%, which matters a lot because that's pure software revenue at high margins. And then there's the future pipeline. Cybercab and Tesla Semi are entering volume production this year. The Optimus robot factory is breaking ground. Robotaxi just went live in Dallas and Houston without a safety driver. And Tesla completed the design of their next-generation AI5 chip. So what's the bottom line? Despite some noise, softer energy revenue, rising R&D costs, and modest delivery growth, this was genuinely a strong quarter for Tesla. Margins are expanding, cash is growing, profitability nearly tripled year over year, and the foundation for their AI and autonomy business is being laid right now. If even half of what they're building hits, the Q1 2026 report might look like the beginning of something much bigger. But the report is just the starting point. Because for Tesla, the real story has always been about growth. And historically, that growth has been nothing short of extraordinary. From 2016 to 2023, Tesla went from roughly $7 billion in revenue to almost $97 billion. That's consistent, strong double-digit growth over nearly a decade, the kind of expansion that justified a premium valuation and built the entire bull case around the company. But that's where the story starts to change. Because once you move past 2023, the trajectory looks very different. In 2024, revenue growth slowed to just around 1%. In 2025, revenue actually declined by roughly 3%. So instead of accelerating, Tesla is now dealing with stagnation and even contraction. And looking forward, the expectations are trying to recover that narrative, but not without uncertainty. For 2026, analysts are projecting around 7.5% revenue growth, a modest rebound, but still far from the levels the market got used to. Then, expectations pick up more meaningfully, around 17% growth in 2027 and roughly 15% in 2028. So the market is clearly pricing in a re-acceleration. But that creates a gap between what Tesla has recently delivered and what it now needs to deliver to justify its valuation. Because at this point, Tesla is no longer being valued as a hyper-growth company based on current performance. It's being valued on the assumption that high growth is coming back. And that's a much more fragile story. But to really understand this, we need to look at profitability in a relative context. So I compared Tesla to a group of peers, Ford, General Motors, BYD, and NIO across key metrics. And at first glance, Tesla still looks like the best in class. Gross margins are slightly higher, currently around 18%. Operating margins tell a similar story at about 4.6%, and net margins are also ahead at roughly 4.1%. So on the surface, Tesla is still leading. But the gap isn't nearly as wide as it used to be, and that's where things start to matter. Because when you look at free cash flow, Tesla actually falls behind some of the legacy players like Ford and GM, with an FCF margin of around 6.6%. Part of that is explained by higher capex. Tesla is investing aggressively, with around $25 billion in planned capital expenditures, and that shows up in the numbers. For example, operating cash flow relative to sales is still strong at about 15.6%, which suggests the core business is generating solid cash. And even on capital efficiency, Tesla still leads, with ROIC at around 4.9%. But here's the key point. Even though Tesla still looks slightly better across most metrics, the advantage is no longer dramatic. And more importantly, the absolute levels themselves aren't particularly high. What's interesting is how analysts are modeling the future. Over the next 2 years, revenue is expected to grow at a CAGR of around 12.3%. But EPS is projected to grow much faster, at roughly 35.7% annually, which implies a meaningful expansion in margins. In other words, the market isn't just expecting growth, it's expecting Tesla to become significantly more profitable again. So yes, Tesla may still be best in class. But for a company trading at such a significant premium, slightly better today, and expectations of improvement tomorrow, may still not be enough. Because at this valuation, the market isn't pricing Tesla as just the best automaker. It's pricing it as something far beyond that. Which brings us to valuation. And this is where the disconnect becomes hard to ignore. Right now, Tesla is trading at around 345 times earnings. Over the past 5 years, its average has been closer to 130. On a cash flow basis, the picture looks just as extreme, with a price-to-free cash flow multiple of around 200 and roughly 85 times operating cash flow. These are exceptionally high multiples. In fact, on a PE basis, Tesla is one of the most expensive companies in the S&P 500. And yes, there are other expensive names in the index, but many of them are either significantly more profitable or expected to grow much faster. Take Palantir, for example. It's also trading at a very high multiple, around 227 times earnings, but still meaningfully below Tesla. And more importantly, the growth profile looks very different. Analysts are expecting roughly 52% revenue CAGR over the next 2 years, and about 61% EPS CAGR. So while Palantir is expensive, the underlying growth and profitability dynamics make that valuation somewhat easier to justify. Tesla, on the other hand, is priced at a level that implies a much stronger combination of growth and profitability than what the company is currently delivering. In other words, the valuation is not just high, it's ahead of the fundamentals. And when that gap appears, the next step is to quantify it. So let's move from multiples to intrinsic value, starting with a discounted cash flow. All of the assumptions are on screen, and it's important to say, these are not conservative. I'm using a relatively optimistic discount rate, with WACC ranging between 8% and 10% across my bear, base, and bull cases. Even with those assumptions, the model points to a weighted target price of around $118 per share. With the stock currently trading around $376, that implies roughly a 68% downside. And even in the bull case, where most of the optimism is priced in, the valuation comes out to about $231 per share. That's still a 38% downside from current levels. So from a DCF perspective, it's very difficult to justify the current valuation. The market is pricing Tesla at a level that simply isn't supported by the underlying cash flow assumptions, even generous ones. And this isn't just a DCF story. If you look at an EV to EBITDA exit multiple approach, again using elevated multiples in the range of 40x to 60x, you get to a weighted 5-year target of around $302, which is still below where the stock trades today. Even if we push this further and assume much higher multiples, say around 70x to 90x, the picture doesn't change as much as you might expect. At those levels, the weighted target price comes out to roughly $468 over a 5-year horizon, which implies only about a 4.5% annual return. And it's also a very big question whether Tesla will still be trading at those kinds of extreme multiples, 70x, 80x, 90x, 5 years from now. And for the level of risk involved, that's simply not an attractive investment profile. So across both frameworks, the conclusion is consistent. Tesla is trading at a significant premium, and based on fundamentals, that premium looks extremely difficult to justify. At these levels, the stock isn't just expensive, it's pricing in an outcome that leaves very little room for error. To understand the potential returns from current levels, I built a simple sensitivity table based on EPS growth and exit multiples. On the growth side, I'm using a range of 24% to 42% EPS CAGR over the next 5 years, which is already a very optimistic assumption set. On the valuation side, I'm applying exit PE multiples ranging from 40x to 85x. And what the table shows is quite clear. In almost all combinations, returns are either negative or in low single digits. In other words, even with aggressive growth assumptions, the outcome is still very sensitive to where the multiple ends up 5 years from now. If we assume that this range is actually too conservative, and instead use a higher multiple range, closer to 100x to 145x, which is more in line with Tesla's historical average over the past 5 years, the picture improves. Under that scenario, with around 36% EPS CAGR and a 130 exit multiple, you get to roughly a 12% annualized return. But even then, 2 things stand out. First, the return profile is still very dependent on the assumption of sustained high multiples. And second, and more importantly, it assumes that the market will continue to assign Tesla the same kind of premium valuation it has historically enjoyed. And that is a very big assumption. Because in my view, it is unlikely that these kinds of extreme market multiples will persist in 5 years' time, especially at the same magnitude we've seen in the past cycle. Which brings us back to the core issue. Valuation is doing most of the work in the investment case. Putting everything together, the earnings, growth trajectory, profitability profile, and valuation work, the overall picture becomes much clearer. The recent report itself was not particularly weak, but it also didn't change the broader trend we've been seeing. Growth has clearly slowed compared to the 2016-2023 expansion phase. Profitability has stabilized but not meaningfully reaccelerated. And the market is now relying heavily on future assumptions to justify the current pricing. When you put everything together, historical growth normalization, margin compression relative to peak levels, peer comparison on profitability, and especially the valuation work across DCF and multiple-based frameworks, the gap between fundamentals and market expectations becomes very difficult to ignore. Even under optimistic assumptions, whether it's strong EPS growth, margin expansion, or elevated exit multiples, the implied returns from current levels remain highly dependent on sustained premium valuation being maintained for years. And that is the key risk. Because in my view, the current pricing already assumes a level of execution and consistency that goes well beyond what the recent financials and peer relative metrics support. So while Tesla is still a strong company operationally, from an investment perspective at this price level, it's not a buy in my opinion. It looks fundamentally disconnected from what the underlying business is currently delivering. If you enjoyed this breakdown, feel free to like and subscribe. It helps a lot and supports the channel. And as always, this is just my own analysis, not financial advice. Thanks for watching. See you in the next one.